Coming into the day, you know that today is the last day of the month for trading, June 28th. And so therefore you should be aware of the monthly chart since traders might try to change the monthly chart. However, the thing is, I don't think this month was all that important. Bulls obviously wanted to close as much on its high as possible, and Bears wanted to drive as big of a tail as possible. But the reality is, the Bears weren't going to get a big enough day to undo anything the Bulls did here. So for today, usually the monthly chart is rather important at the end of the month, especially if you're around the midpoint. But it wasn't overly important today. I think the best thing the Bulls could have done was close it on its high. They weren't quite able to do that, but we still have consecutive bull bars and this open gap. So coming into the day, you should have been aware of that, or it's smart for traders to be aware of that. And, a lot of times on the open, you will get some sort of spike, but then you'll get a measured move based on the spike, but it doesn't always have to be the upside. And today it was not. So today we actually got a measured move based on the spike to the downside, and that's where the low of the day was. So, again, whenever you get a big spike on the open, I should have, in this, I'll just pull out a couple of examples. Spike, 3 bars down, and measured move. You can see spike down, measured move down, low of the day. Measured move up of the opening spike. So it's pretty common. It's a pretty common pattern. This was a leg 1, leg 2. We actually had a leg 1, leg 2 as well today. So you can see we got this measured move down, and then the leg 1, leg 2 happened around the midday reversal. So if you're paying attention on bar 39, it's a spike and then a wedge channel, 1, 2, 3, and it's a bit of an overshoot of the wedge channel. When you have an overshoot, it further increases the probability of the swing up. And when you're getting a swing up, you should expect it to test around the midpoint or around the top of the channel, and the top of the channel was here. Also, a bull bar closing near its high that hasn't been tested increased the odds we were going here even more. And furthermore, the bar 9 close was never tested. So you think 80% chance if you bought the close of bar 9, you're buying more above a good-looking bull bar like 39, that you're going to be able to get out at break even. So I thought buying above 39, there's at least a 60% chance of a swing up. So I thought 39 was the best trade of the day. The reason that I point that out is because that's where this first leg down ended. So if you start with the spike, bar 17, to the end of the first leg down, because 39 was the most credible reversal, we end up getting a second leg down. So leg 1 pullback, leg 2. So we ended up getting basically the exact same area. So there were multiple important measured moves down here, which is one of the reasons why 73 happened. And we got a vacuum test down. Additionally to that, it was, you could pay attention to the weekly chart. And if you were paying attention to the weekly chart, you would have noticed that the open of the week was 55.31. So what we were basically trying to do for most of this was get down to the open of the week, which is right here. And you can see we closed 3 ticks above the open of the week. So still a bull close on the weekly chart, which is a win for the Bulls. Granted, not the best looking week, but I'll go over the weekly chart in a little bit and the monthly chart. Bar 1, a bull bar closing near its high. It's good for the Bulls. It's closing above yesterday's high. We're probably going at least a little bit higher, but there's a big tail on the bottom. So it's not quite as good as it could be with all of this overlap with this rally from yesterday. But probably always in long from this. So good bull bar closing near its high, probably going at least a little bit higher. Bar 2, consecutive bull bars closing near their highs. Good for the Bulls. So consecutive bull bars closing near their highs on the open means we're probably always in long. If we are always in long, potential bull trend from the open. Bar 3, an inside bar, a high 1. Something to notice is the market often tries to repeat patterns, and I thought that's what it was going to do here. You can see we had consecutive bull bars and then a doji inside bar. Consecutive bull bars and then a doji inside bar. And I thought we were going to try and get a reversal down closing near its low on bar 4. Bar 4 was closing near its low for a good portion of the bar, and if we had gotten it closing near its low and it wasn't quite an outside bar, it would have increased the chances that this was the high of the day and we started to sell off from over here. The fact that yesterday was a credible high of the day and it was the exact same pattern and it failed, I think at least makes it a little more likely that this one is going to succeed if 4 closed on its low. So had bar 4 closed on its low, it would have been a really credible short. Instead, bar 4 closes on its high. Now, we do have consecutive bull bars, 1, 2. The doji bar 3 isn't great. Whenever you get a doji in a buy the close trend, it means that the buy the close is probably coming to an end pretty soon. However, still reasonable to buy above bar 4, a follow-through bar for the high 1. Bar 5, it's a bad low 1 short for the Bears. The Bulls see follow-through for bar 4. You know that either way, however you'd like to look at it, there are going to be buyers below bar 5. So buyers below 5 during 6, a small bar. Could be 1, pullback, 2, and maybe we'll get a third leg up. And then obviously we get this humongous buy climax on bar 7. You could argue it's a parabolic wedge with yesterday, 1, and then 2, and then the 3 was an overshoot on bar 7. Is bar 7 a buy the close bar? Yes and no. It's a theoretical buy the close bar. There are algorithms that will buy the close, but as a trader, it's probably better to just let it go. It's such a huge climactic bar that unless the follow-through bar pretty much looks exactly like it, it's probably a really big climax. And it's really hard to want to buy this far above the moving average. At this point, we're so, bar 7, we're so far above the moving average that buying up here doesn't really make a lot of sense. More follow-through for the bulls on bar 8, but just look at the size of 8 compared to 7. It's like, 25, bar 8 is basically 25% of the size of bar 7. That's not what you want to see. This hints more at a channel. So this spike, and this looks more like, 8, 9 looks more like a channel than it does a continuation of the spike. So really, although 8 is follow through, it's likely we're going to find profit taking up here pretty soon. I would rather just not be long. I'd rather wait and see what happens. It's most likely we're going to end up getting a pullback. Follow through again on bar 9 for the bulls. So we have 3 straight bull bars, all reasonable and closing reasonably decent. We should get a second leg sideways up, but I'm not sure. How far down we have to go first. This seems like it's pretty climactic and unlikely to continue with how big these bars are. And then you get bar 10. That's why you get bar 10, because bulls, a lot of bulls just out of principle are not going to buy, 15 to 20 points above the moving average. If you're buying above bar 9, you are, buying quite literally like 20 points above the moving average. A lot of traders are just not going to do that. They'll just let it go. So that's why there's a lack of buyers up here. And that's why 10 is a bear bar closing near its low. 11, a reversal up for the bulls, trying to test the bar 9 close. Interestingly enough, like I had said, we never quite got there, which was interesting. I did think we were going to have to get all the way up there. But bar 11, an inside bar, it's a high 1 for the bulls. But after bar 10, you know that we're probably going to get a second leg sideways to down. And after bar 10, you know that you don't want to, well, just in general, after bar 10, the pullback has started. And so we're probably going to be sideways for an hour or two. So it's better not to really do anything. I would rather just wait and see what happens. What do the bulls want? Well, the bulls want pullback for, an hour, hour and a half, and then a rally. And they want to keep the gap open with the bar 5 high. Why the bar 5 high? Because the bears who shorted above here probably should have made money. It wasn't a terrible sell. It wasn't great because bull trend, but generally bears fading breakout points are going to make money. And traders were expecting them to make money. However, they got trapped on 7, 8, and 9. So what does that mean? It means if we get a breakout below the bull flag like we did on 17, you should be expecting us to test back to at least the bar 5 high. Bulls want to keep the gap open, get a couple legs sideways down, and then a big second leg up. So maybe 1 and then pull back and then 2 or something along those lines. 12, a bear bar, but testing back towards the bar 10 close. Any bear who sold the close at 10 is going to be disappointed with 11. They were probably expecting it, but they are still going to be disappointed. So they will buy back their shorts around the 10 low during bar 12. 13, a bull bar, probably sellers above 12. Bears hoping this is the spike, and now we're getting a 2-legged pullback, and then we're going to start some sort of move down. Bulls, again, hoping we just continue sideways for a couple more bars before they can get a rally. 14, a bear bar closing near its low, but not really worth selling, I don't think. It's a lower high, yeah, but I don't know. I didn't really think it was worth trying to sell in the middle of the tight trading range after, it was a clear buy climax, so you can just bet on the bull trap, but it's really not all that good. 15, a reversal up. It's a reversal bar for the bulls, but it is a bear close, so it's not really worth selling. I think I would just rather wait and see what happens. However, there's probably more sellers above than there are buyers because, potential wedge, maybe bar 9, bar 10, and bar 15. It is just in general 3 pushes down, 10, 12, 14, 15. So you look at it either way. So we might get 2 legs sideways to up, but 15 is really not a very good buy signal bar. The upside is probably extremely limited. Again, we still haven't touched the moving average yet today, and you have to be expecting that we're going to do that. 16, follow through for the bulls, but it's not very good. It's a smaller bar. It's not really surprising to anybody. The bulls need a follow through bar if they want to basically get anything going out of this, and they're pretty unlikely to get it. So I think better to wait rather than do anything. And then sure enough, you get outside down 17 when the bulls needed, one more pretty strong bar. So 17, you had the bull flag, basically the wedge to 15, and 17 is the breakout below the bull flag. Again, at this point, you should be basically looking at the bar 5 high. you know that whenever we touch the moving average for the first time all day, there are going to be traders looking to buy it. And so there might be some traders buying, a bit more buying the close of 17 rather than selling it, betting that this is going to end up being a trading range and that they're going to at least get a bounce at the moving average that they can make a scalp on. However, that's really not all that great of an idea because, you got to think about it from the concept of I could buy here. If you're thinking you're a trader, you say, okay, well, I could buy here, but I know we're going here. So why don't I just wait until we go, 5 points lower and then buy there? That's exactly what happened on 18. We traded back down to the 5 high and traders bought back their shorts. Shorts at the 5 high and bulls bought for a scalp. And then when 18 was unable to close above the moving average or on its high, it ended up just being a bear bar. A lot of those traders exited and we get big bear follow through 19. We have 3 consecutive bear bars, 17, 18, 19. We're probably going at least a little bit lower. But to me, at this point in the day, I see big up, big down, big confusion seems more likely, and a trading range day seems more likely. Note the context on the daily chart, we're pretty overbought, so it's not unreasonable to think we might get some sort of sell-off here. However, with how strong the rally was on the open, I thought it was more likely that we were going to end up being sideways. 20, more follow through for the bears. So again, big up, big down. At this point in the day, I was thinking trading range seemed the most likely. We might get a little bit more of the downside, but I wasn't all that sure we were going too far. And then inside bar 21, it's not really worth doing anything here. I think I would just rather wait. If you're short, you can look to get out a couple points above 21 or above a bull bar closing near its high 22. But it's hard to want to buy above 21 after the 4 consecutive bear bars. I think that 22 is a credible buy because it's an inside pattern after a sell climax. So that's reasonable. However, it is still a sell climax, 17, 18, 19, 20. So if you're taking the buy, you have to understand what's most likely going to happen is the market's going to go sideways before it goes up. So traders buying above 22, no, they're not going to get a bar that looks like 7. That's really rare. It's so rare, it's not worth even, considering that happening. But I think it's more likely that the traders buying above 22 are looking for some sort of move to the middle right here, the midpoint of bar 9 and bar 22. They're looking to get somewhere in this range. So I thought a reasonable buy, sell climax, and then an II after a sell climax. So okay to buy above 22, looking for a move up. Follow through 23, but really not as good as it could be. Again, I'm expecting another leg down from this, but overall, I am expecting a bounce here. So sure enough, we end up getting disappointing follow through on 24. Buyers below 23, 22, and 21, as you can see, looking for at least a second leg up from 21, 22, 23. You did get your second leg up. I thought it was pretty okay to hold. So what you're thinking here, there were 3 bars today that should not have happened for the bulls if they were going to get the reversal. If we were going to get the bounce into the middle of this range, 27 should not have happened. If you were watching 27, about 3 minutes into the bar, it was sitting around here, and then it just went boom, immediately down to here, like a couple minutes into the bar. The reason that happens is because bulls decided to give up. They decided they were done with the trade and that it wasn't quite doing what they wanted, so they gave up. So this is a big problem for bulls, and it's going to force a lot of other bulls to give up, which is causing this. Bar 48 should not have happened either. If you bought here, after 44, it's a buy climax, and you are expecting maybe a little bit of a pullback, but 48 should not have happened. It's a way too big of a bear bar closing near its low. Most bulls are going to exit below 48. There's still reasonable hope of a midday reversal. Not a midday reversal, but at 39 is the low of the day. We can bounce back up to the top of the channel. So what are bulls doing? They might buy above 54, 55, hoping that we're going to get the break above the moving average. You can see we struggled at the moving average. We've struggled at the moving average. So the question becomes, can bulls get 58? You get 57, okay, above the moving average, but 58 needs to be a bull bar closing near its high, fully above the moving average in order for me to be convinced that we're going to go higher. And instead, we got a bear bar closing near its low, and so bulls dumped. So, bulls give up, bulls gave up, bulls giving up again. And so it's something to look out for is when you think, okay, well, how many tries are they going to get, right? You can see bulls got a couple chances. They got a couple chances. They got a couple chances. And when the bears keep giving the bulls chances and the bulls keep failing to take advantage of it, at a certain point, the market's going to flip in the other direction and traders are going to give up. It takes a long time to develop the sense as to when those traders might give up, but if you watch the market for long enough, we'll start to figure it out. So like I said, buyers down here most likely and a second leg up. So big tail 24 and a bull bar closing near its high 25. I think it's a credible buy on 25. You are buying relatively near the moving average, which isn't great. And it could be just a second leg up for the bulls. But again, overall, I do think we are going to end up going higher here. 26, another bull bar closing near its high. It's consecutive bull bars closing near their highs. It's not great that 26 has a huge tail overlapping 25. However, there is buying pressure in that area. I think that this leg up is pretty strong, 26, 27, and the move up from 21 to 23 was reasonably strong as well. So some traders might argue it's 2 legs up, but I thought the 2 legs up were, relatively noteworthy with how big and strong the bars were in them. So basically, what I'm trying to say is I thought that this was forming the bottom of a trading range. It seemed reasonably likely that that's what we were doing here. You can see we ended up keeping open gaps for the bears, which is really important, that we were never able to get back to this low. Shows that we have a lot of trap bulls. So 27, like I said, bulls give up. It's an outside pattern, outside bar 26, outside bar 27, and this was really disappointing for the bulls. It should not have been allowed to happen if we were going to get it back up into this part of the range. But outside down, failure at the moving average, a lot of bulls give up below 27. You sell below 27? I don't know. I don't really think it's all that ideal because of the tail, but it's certainly not unreasonable. 28, it's an IOI pattern, so an inside. So 26 is inside 27, it's inside 28, or 28 is inside 27. So an IOI pattern, and it's maybe a reasonable sell below 28 if we get there. Probably not the best buy in the world above 28 since it's a bear bar. But I still thought the context was reasonably good, and I thought that if 29 could close on its high, that would be really good for the bulls, and it would be more likely we're going higher. 29 seemed like the last gasp of air for the bulls to see if we can end up getting a rally. And instead, we get a disappointing doji bar. So bulls are probably disappointed. 30, probably buyers below 29, but they might be scalping. Traders might buy below 29, hoping that 30 is going to turn into a big outside up bar and close somewhere up in here and then end up going into the middle of the range. And if they do that and they see the close of 30, what are you thinking? You're thinking, well, this is not what I wanted to see. I wanted to see a big bull bar closing near its high, and instead I got a doji bar. So what am I going to do? I'm going to scalp out of the trade. So the traders scalp out at the 30 high and take, whatever, two-ish points it seems like they got, and they just exit the trade. 31, I think, is, part of that. So traders exiting, that's probably a big piece of what caused 31. It's really not very good to be, nothing looks great in here, right? I thought you could sell below 31, but it was mainly just because I thought the bulls had enough chances and that they were probably going to give up soon. So, it's an outside down bar, and bulls keep failing at the moving average. So it's probably just in general not unreasonable to sell below 31. But the way that I looked at it is the only reason I even considered it, I did not take it, but the only reason I even considered it was because I thought the bulls had enough chances and it didn't seem like they were getting the job done. So that made it a bit more likely that we were going to sell off. Sure enough, we get a bit of a collapse bar on 32. Follow through 33, but tail 32, tail 33. Outside down 34. So we're getting, this is good for the bears. We're getting a spike down. The question becomes, are we going to get back to the bar 20 low? That's going to be the important price point. And instead, we get the reversal up 35. It's an IOI pattern, 33, 34, 35. What's my problem with buying 35? So obviously it is an IOI, which is good for the bulls, right? It's a breakout mode pattern. However, it doesn't close on its high, bar 35. And it's a little bit too early for this reversal. Generally, if you're going to get a midday reversal, it's going to be around bar, 39, 40, 41, 42, that general area. I generally 39 to 42 is when you end up seeing midday reversal, sometimes 38. You can be a little bit flexible with it, but 35 is definitely a little bit too early. So it's not quite as good as it could be. And why does 35 not close on its high? Why is there a tail on 35? There shouldn't be a tail on 35 if this trade's going to work. So the follow through on 36 is relatively disappointing. If it was a bull bar closing near its high, some traders might say, okay, well, it wasn't ideal, but it got good follow through, so I'll buy it. But instead, it has a big tail on the top. And so traders, they give up above the bar. We get an outside down bar 37. 37 triggers a low one short below 36. We're probably going a little bit lower, but I don't know if we're going to get some sort of humongous breakout here. More follow through on 38, possibly, a wedge channel, 24, 34, 39, something like that. Or, that's the steeper one. You could say, I looked at it as bar 20 and 34 and 39 were the wedge, and it was an overshoot of the channel line on 39. So 39, like I mentioned for the reasons earlier, should reach the midpoint between here and here, should at least reach the midpoint between here and here. And I thought we could easily test all the way back up to the high of the channel, send spike, pull back channel. I thought the top of the channel is going to be a magnet and it might turn into a trading range. So 39, you can't really ask for more as a trader, I don't think, than to buy above 39. I would say 60% chance of a swing up. Disappointing follow through. You could also say, consecutive sell climaxes. 1, pullback, 2, pullback, 3. So consecutive sell climaxes. just there's a lot of, double bottom, right, with over here. I'm trying to list all the reasons. Is it a lower low? So it's a slightly lower low double bottom, which means we might go a little more sideways first, but just because of the consecutive sell climaxes and the general nature of this kind of trade, you're expecting the market to go a little bit more sideways first. But definitely a good buy above 39. Disappointing follow through on 40, a doji bar, but it's kind of expected with how sideways you're probably expecting the market to be. Again, it should go sideways for 4 or 5 bars. 41, follow through for the bulls, but a doji bar. Again, I think that at this point, we're always in short, yes, but the context might be more always in long. I think traders are going to be a lot more willing to buy in this area than they're going to be willing to sell. Selling bars like 38, you're selling with giant risk at the bottom of what's probably going to, the bottom of the channel, you could say, and it's probably going to be some sort of trading range. It's really not all that great to be shorting bars like 38. If you do, you need to reverse above 39. 42, more follow through for the bulls. Probably buyers not too far below. You can see the traders bought below during 43. When I bought, so I did buy 39. I had a wide stop initially, expecting that, maybe we get one more leg sideways to down. But realistically, if this is going to go, it shouldn't even get below 39. We should probably just start to rally immediately. And then sure enough, you get a big bull bar 44. For the bulls, they're thinking, okay, 44, this is going to be the chance for the bulls. So this is going to be where we start the rally. You know that 44 is closing on the moving average, and traders have had trouble at the moving average so far today. So it's possible we go a little more sideways before we go up, but I still thought the odds favored a rally for the bulls. 45, not an inside bar, but bad follow through for the buying above 44. But again, kind of somewhat expected. I think you're going to expect the market to go sideways here. And an inside bar, 46. Disappointing for the bulls. You probably did not quite want to see that. You do need to get a bull bar closing above the moving average relatively soon. The bulls have struggled to get bull bars above the moving average. They weren't quite able to do it earlier with bar 27 happening. So they do need to get a bull bar closing above the moving average relatively soon here. The most recent sell climax high, so the first target for any sort of reversal is the most recent sell climax high. So for a bull reversal, the most recent sell climax high would be a target. For a bear reversal, the most recent buy climax low would be a target. So you can see here, the first target would be 37 high, or the 37 open. And huge bull bar 45, disappointment 46, and then bear bar closing below the moving average 47, getting a bit concerning for the bulls. Zoom in a little bit. And then you can see we ended up finding sellers above 47. So I wanted 47. If you're a bull, you wanted to see 47 close on its high, and you wanted to get to at least this low and close that gap. You knew that this was a buy climax, so it might go a little bit sideways first, but it's starting to test the bull's patience, with 47 not being able to close above the moving average. And then you get this bar 48. 48 doesn't happen if this reversal is going to work. So 48 is a really big disappointment bar. I think we're getting at least 2 legs sideways down. Bulls will exit below 48, and bears can sell, but this is a pretty tight channel up, so we might go more sideways first. But I think it's reasonable to take the short below 48. Follow through 49 for the bears, so consecutive bear bars, closing near their lows, always in short. We're probably going at least a little bit lower. You can see we ended up getting back to the bar 38 close around before we found buyers. 50, a reversal up, a bull bar, closing somewhat near its high. Am I buying above 50? I don't know. I think that if this was going to go, it probably would have gone up here, or we're going to get some sort of big surprise later. So I'm not really willing to buy above small signal bars. 51, a second leg down. 48, 49, first leg, pull back 50, and second leg down 51. So probably, again, going at least a little bit lower, but I'm not sure how much lower. Then an inside bar 52. This should not be happening if this is going to work. The bull's chance was here. A pullback was fine, but what was critical, I think, was to keep a gap open. So 44 being a big bull bar, they were hoping to trap the traders who sold above 42 and force bears out of their shorts and force a rally back up into here. But instead, we ended up getting 48, disappointing bulls, and the bulls are the ones forced out. And so this should not be happening if we're going to end up getting the rally. The only chance the bulls have is a big bull surprise. 54, basically a big high two, or some sort of high two, higher low double bottom, but giving you a better entry price than 39, which is the original buy. So it's suspect. 55, an outside up bull bar. That's the surprise the bulls wanted. So this is now the bulls' chance. What do the bulls need? Well, they need something closing above the moving average, and they need it rather quickly, and they need to get consecutive bull bars closing above the moving average. There's still enough time in the day. There's still, a little over 20 bars left in the day. We can still make it up here, but this needs to start now. So if this is going to be a bull trend, it's going to do it basically right now. A high 158, not great, but okay, still reasonable to be long. Stop below 55 at this point. If we go down here, your premise is not valid. So your stop's going to be below here, And if you're buying anywhere up in here, 57, a bull bar, you can probably buy above 57. I think you can buy in this area. But again, you need to see a bull bar closing near its highs pretty much immediately. You need it on 58. You need a bull close 58 above the moving average. It's pretty much all the bulls we're looking for. Even if it was a doji bar, it would have bought the bulls more time, because then 59 could be that big bull bar closing near its high that they need. The give up bar for the bears, right? That's what you're looking for, is the bears to just give up and for the market to start forcing itself higher. Instead, you get 58, a bear bar closing near its low. At this point, if you're a bull, that's just atrocious. You do not want to see that at all. You were hoping you were going to get a breakout to the upside. And instead, for the third time today, we're failing at the moving average. Bears selling at the moving average has been a reliable play. And now 58, you're getting a small signal bar closing near its low at the moving average in a day where the moving average sells has been reliable. But I think 58, really strong trade, and traders sell below it. And you can see they make 10 points. Exactly 10 points on 59, and they're going to scalp out with 10 points. Why? Because there are probably still buyers below 39. This is a reasonably strong breakout. So the breakout point might end up leading to some sort of bounce. And in general, if you're going to sell a bar like this and you get a really fast 10 points, a lot of traders will just take it. We might have to get to the open of the week. I think we're, a point or two away from it, but it's not really worth staying short, I don't think, if you sold below 59. 60, an inside bar low one short closing near its low. I would not sell it. I think you're selling too low, and there's too much risk of a reversal up. If you do sell 60, you just get out above any bull bar closing near its high, which would be somewhere over here. 61, kind of bad follow through. Probably sellers above for a second leg down. So selling above 61 probably made a lot of sense. And if you get a bull bar closing near its high, you just get out. But you end up finding sellers, and a bear bar closing near its low 62. This could be the second leg down. Follow through 63, but a big tail on the top and a tail on the bottom. This is the channel down, right? The tail on 60 and the tail on 62 and the tail on 63 are pullbacks within the bear trend. So as much as it is a bear trend, you have to keep in mind this is the channel phase within the bear trend. 64, follow through bar. It's a bit climactic, breaking out below the bear channel. And that's why some traders buying back their shorts at the close of 64, causing 65. An inside bar, 66, so an IOI pattern. Probably more of a final flag than anything else. And it's a doji bar, so even if we do sell off to it, or if we do sell off, we should test back to the bar 66 open, most likely open and close. 67, follow through for the bears, but probably buyers not too far below, and a reversal up 68. I'm not really willing to buy anything down here. I'm not willing to buy 70. It is an IOI pattern to 70, but I think that if we were going to rally, we would have already done it. So, and that's part of what I'm talking about, where you can tell if the bulls have had enough chances. I think by 70, the bulls have had plenty of chances. So the bulls, I'm not willing to take a chance on the bulls anymore. Bar 39, I was happy to take a chance on the bulls. Even bar probably 55, still happy to take a chance on the bulls that they can get strong closes above the moving average. Still, buying above 39, your thesis was it was the low of the day. So it's not, technically wrong to just buy and hold through all of this. But you got to get out here. This is just terrible. So I think that the bulls have had enough chances on 70, so I'm not willing to buy. The bulls who do buy, what are they looking for? They're looking for an explosive bar like 44 to the upside, and for the bears to start quickly covering shorts and we get a good rally. Instead, you get a doji bar 71. So what do? They buy back, or they exit their longs around break even during 72, causing the bear bar closing near its low. Am I selling below 72? I don't know. I probably wouldn't. I'd probably rather just wait and for tomorrow. These are decently strong bars, but you can see we end up getting a collapse down to the measured moves and a reversal up 74. You can buy 74, taking a chance that this is the rally, but look how disappointed you've been if you've been doing that all day. So it's reasonable to buy above 74, but you probably are just the first sign of disappointment you're getting out. And 75 is disappointing. Maybe you give it one more bar, but 76 not being able to close near its high. And then as 77 is going outside down, you probably just got to find a way to get out at break even. I would say as 77 goes outside down, worst case, you get out break even, because it shouldn't be doing that. If you're buying with 3 bars left in the day, you need the market to immediately go in your direction. Otherwise, the trade is really not worth it, and you're probably going to end up losing money. For stop orders on the day, you could have bought the close of 2, probably 4. I thought it made sense to sell 17, trying to get back to the 4 or to the bar 5 high. And, you could just also hold with the premise that we're going to get a breakout to the downside of the 18 bar range rather than to the upside of the 18 bar range, because 90% chance coming into every single day that you're going to get a breakout to the up or downside of the 18 bar range. And bar 17 is a breakout below a bull flag. So it's not unreasonable to sell and just think we're going to get a downside breakout, especially considering the context on the daily chart. We were somewhat due for a sell-off. You end up getting follow through. I thought 22 was a reasonable buy. I honestly thought 25 you could buy. It's not super great, but I do think that the odds favored us being in the trading range and going a little more sideways here. The one thing that was noteworthy was that we hadn't broken out of the 18 bar range yet. So if we do go sideways, it's possible today is one of those rare days where we do not get the breakout. 27, disappointing. Maybe you could sell. Probably sellers above 28. I don't know if I wouldn't sell. You could probably sell 31. I just think the idea makes more sense than the setup itself, if that makes sense. So like the idea of the Bulls have had enough chances and they're probably going to give up is why you would sell 31, not because it's some big bear bar closing near its low. I probably wouldn't take any other sells. You can maybe sell to close 32, but it's tough. You're not going to sit through 35. I think you have to get out above 35, so it's kind of difficult. And then I would not sell 38. That's too low. It might be consecutive sell climaxes to move to 20, then move to 33, and then move to 38. So 3 sell climaxes. If you do, you get out above 39. You buy above 39. You can probably buy above 44 if you want to, but I would just rather wait and see the breakout at that point. It would make a lot of sense to buy above 39. I wouldn't wait for follow through on that kind of trade. 48 you could sell, but it might be more of a minor reversal. I thought you could, buy 54, 55, kind of just taking a chance that we end up getting to rally, but you have to get out below 58. It makes a lot of sense to sell below 58. And I don't know, it's probably sell to close 60, 62, 63, but it's not really that good because of all the tails. So I'd just let it go. And I would not buy 70. You could probably buy 74, but just be quick to get out. On the daily chart, big outside down. So really, what is this? It's tight trading range, right? Really what's happening is we're forming a tight trading range. When you form a tight trading range deep in a bull trend, it's probably becoming a final flag. A lot of times with final flags, you'll get a final breakout above and then a dramatic reversal down. It's possible we end up doing that. I'm not sure when. I'm not sure how long this tight trading range is going to go. But to me, it seems pretty evident we're in a tight trading range. Although it was not good for the bears that they were not quite able to close the market on or near its low. The weekly chart, this is not that ideal for the bulls. Again, I think we're closing the gap with this high. We're probably going to come back to it. And this still might have started the trading range. I'll be curious to see what happens if we, we're probably getting back into this area. I don't know, relatively soon. I don't know, maybe the next 10 to 15 bars. We're probably getting back down here. I just don't know if the trading range started here and this was the final leg up. That's stronger than it should have been, and we might end up going up and down into this range, or if it's just going to pull back to here and we're going to form a range in the upper range. Not really sure. But this was strong enough that we might have to test back down to this area, or if we get a bear reversal bar, at least the midpoint of this close and whatever the bear reversal bar is. On the monthly chart, a lot of good bull bars. Consecutive bull bars. So good for the bulls, probably going at least a little bit higher. How much higher? I'm not sure, but again, consecutive bull bars closing near the high is good for the bulls. They're trying to keep an open gap with the May high and the April high. So, that's today.